Good morning, everyone, and thank you for joining us today. With wealth in the UK concentrated at older ages and longevity increasing, if ever there was a time to discuss the wider financial family issues and needs with clients, it's now. So today's CIO accredited webinar covers this important topic. For those of you that don't know me, I'm Lee Badger, the Intermediary Distribution Manager at Scottish Widows in the South West. And I'm joined on this session by Tom Coughlin, Financial Planning Manager, who will spend the next 30 minutes or so presenting the main content. Please do use the Q&A box on your screen to submit your questions at any point during the presentation. Please note that all questions are submitted anonymously, so we'll keep a lookout for some key themes that we can answer towards the end of the session. The webinar is being recorded, and we will share the on-demand link with everybody who registered for this session tomorrow. You can request a certificate for this webinar by clicking the link in the related content section. Our learning outcomes for today are as follows. To recap the 2015 changes to defined contribution death benefits, outline the inheritance tax treatment of pension death benefits, and detail how beneficiary drawdown may be used for intergenerational planning. Today's event forms part of our expert series where we take on some of the key issues in our industry to help you navigate the changing market. We've been building this content for the last year, including recent sessions on the lifetime allowance rules and a podcast on how statutory maternity leave and pay affects money purchased workplace pensions. Please also do look out for links to future events and emails and on our social media channels. So back to today, and I don't want to waste any more time, so let's get started. Over to you, Tom.
Thank you, Lee. Good morning, everyone, and thank you for your time today. So we're going to look at the recent changes to DC pension death benefits, which include the introduction of beneficiary drawdown and also the simplification of the tax treatment of beneficiaries. We're also going to look at the pension and IHT rules, and these two sets of rules combined have had significant benefits for DC pension holders and potentially open up the possibility of using a personal pension in some cases as an IHT planning vehicle. So the areas that we're going to look at, we'll look at death benefits first. We'll look at the tax treatment of the recipients of those death benefits, and that's the income tax treatment. We'll then move on to nominations and also the successor rules, which then introduce the new rules around beneficiary drawdown. We'll then separately look at pensions and inheritance tax, and then hopefully we'll try and tie those two strands together at the end and look at DC pensions and intergenerational planning. As Lee said, we'll deal with any questions that you submit throughout the presentation at the end. But please just do try and keep the content relevant to the topics that I've mentioned already. So we'll start with DC death benefit changes. So Freedom and Choice introduced on paper relatively small changes to pension death benefits, but in effect they amount to quite significant changes. There were two main areas that were amended. So there was the income tax rules and then drawdown. So prior to April 2015, the only death benefit that was free of income tax was a lump sum paid from uncrystallised funds, and that was where the member was under age 75 when they died. Otherwise, tax charges applied. The drawdown, that was marginal rate. For the lump sum, it was a fixed charge as high as 55%. As I'm sure you remember, that created an unnecessary disincentive to crystallise your benefit, and there should never be a disincentive to crystallise your retirement fund. So thankfully, along with Freedom and Choice, they introduced rules to get rid of that quite distorting rule. So from April 2015, the income tax treatment is based on whether the member died pre or post age 75. The other major rule that was introduced was widening the eligibility of beneficiary drawdown. So prior to April 2015, the only type of drawdown that was available as a death benefit was dependent drawdown. From April 2015 onwards, there are essentially three different types of drawdown for death benefit purposes. They're either dependents drawdown, successors drawdown, or nominees drawdown, and they're all sort of gathered together under the term beneficiary flexi access drawdown. So now a nominated beneficiary can also receive drawdown, which essentially means anyone can now receive beneficiary drawdown subject to that nomination requirement. So just to try and illustrate the significance of those changes, so they're taking one client and looking at the treatment pre and post 2015. So a client who died age 74 had already crystallized funds into a drawdown plan worth $500,000 for her two adult daughters, so non-dependent daughters. Under the pre-2015 rules, then other than an annuity, the only option would have been the lump sum. And because that came from a crystallized fund, then the tax charge would have been 55%. Under the post-2015 rules, then as well as the lump sum, you also have the drawdown option, again, subject to that requirement to make a nomination, but that's quite straightforward. And because the member died under age 75, then those funds are tax-free. So you can see a major difference between the pre and post position for a client in that scenario, in that situation. Just to look in a bit more detail at the pre-75 tax position. So from 6th of April 2015, where a member dies before reaching age 75, then the death benefits are income tax-free in the beneficiary's hands. There is still scope for a lifetime allowance charge. That can still apply in the usual way. So the lump sum itself is free of income tax, provided it is paid within a 2-year payment period. So that 2-year period starts on the date of death, it ends 2 years later, but in some cases it will start when the scheme became aware of the member's death, if that's later, but within a reasonable time frame. Beneficiary drawdown, again, also free of income tax in this situation, doesn't have to be paid out within the 2 years, but the drawdown arrangement itself has to be designated within that same 2-year window. Just to clarify, the tax treatment of a successor, that's a further beneficiary after the current beneficiary, depends not on the age the member died, but on the age the previous beneficiary died. So you could switch between the pre and post 75 position depending on the age at death of the previous beneficiary, not just the age at death of the member. Just to briefly mention the annuity and scheme pension position. So beneficiaries' annuities have similar taxation to beneficiary drawdown, broadly tax-free, provided it's purchased within that same 2-year period. And dependent scheme pensions have their own separate rules. Basically are subject to marginal rate tax, but there's not a lifetime allowance test for dependent scheme pension. Moving on to the post-75 position. So if the member dies on or after age 75, the death benefits are taxed at the beneficiary's marginal rate, whatever that is. There's no lifetime allowance test post-75, but that's simply because it would have already been dealt with at age 75. So if there was a lifetime allowance charge, then the fund would have been reduced at that point. So there's already been a lifetime allowance test, but there isn't one after age 75. So the lump sum death benefit, in this situation, subject to marginal rate tax, post-75, there's no 2-year payment period to be concerned with. And also, same with drawdown as well, subject to marginal rate tax, but again, there's no requirement to designate within a 2-year period. But then, obviously, there's no real reason to wait much longer than that. Once it's in drawdown, it's in a pension environment. And it can be left there until the beneficiary needs it. So there's no reason to delay beyond a significant period. And again, same as on the previous slide, the tax treatment of the successor depends not on the age of the member, but the age the previous beneficiary died. So again, you can have that switch between taxable and tax-free, depending on the age of death of either the member or the most recently deceased beneficiary. And again, beneficiary annuities have a similar taxation position, so marginal rate tax for a post-75 death. Moving on to nominees and successors. So it's always been important to make a nomination that gives the scheme clear guidance as to who should receive the death benefit. But the recent changes make it even more important that there is a clear nomination in place. So those are the rules around beneficiary drawdown. The beneficiary drawdown is only available to a dependent or to someone who has been nominated, and that nomination can be either by the member or the scheme administrator. So you really want to rely on that rule, and if anyone needs beneficiary drawdown, then you either need to check that they're dependent or make sure they are nominated. There is a default rule to fall back on. That is that if there are no dependents or nominees, then beneficiary drawdown can be paid to anyone, but it's perhaps best not to rely on that rule, because then you've not given the scheme any clear guidance as to who should benefit. And if it does turn out that there is a non-dependent, or if it does turn out there is a dependent or nominee, then it excludes all other non-dependent non-nominees. So if there is someone in mind who would benefit from drawdown, then it's good to ensure a nomination is in place with their name on it. A lump sum death benefit can be paid to anyone, but again, you want to make sure that they're nominated to give that scheme that clear direction as to who you want to receive those benefits. It's the same rule with successors. So a successor is just a further beneficiary. It's the subsequent beneficiary after the previous beneficiary. And the rules around beneficiary drawdown are the same. So beneficiary drawdown can be paid to either a dependent or a successor. The dependent is still a dependent of the scheme member, not a dependent of the current beneficiary. So the successor relates to the previous beneficiary, but the dependent rule still relates back to the scheme member. And again, you have the default rule in place as well. So if there are no dependents or nominees or successors, then you can pay drawdown to anyone. But again, best to make sure the nomination is kept up to date rather than to try and fall back on that rule. Okay, just to illustrate how that might work then. So the scheme member during their lifetime perhaps nominate their adult child as a beneficiary. On their death, the nominee can then receive a death benefit, perhaps beneficiary drawdown. Because it's still in the pension environment, they can then nominate their own child perhaps as a further beneficiary. That individual becomes a successor. So on the nominee's death, the successor could then request beneficiary drawdown again and retain the funds in the pension environment. They also have the option to nominate a further successor, and that chain can carry on indefinitely. So you can see from that ability to pass on death benefits via beneficiary drawdown is what potentially allows a personal pension to be used in some cases for some sort of IHT planning. Okay, we'll return back to that bit towards the end, but now we're just going to recap on some of the pensions and IHT rules before we return back to that intergenerational planning point. So just to recap on the general IHT rules first. So as you know, IHT is charged on the estate at death plus any other transfers of value, as that's transfers of values away from the estate, which means that the IHT-able estate is made up of all your non-exempt assets held at death plus transfers of value. So perhaps a potentially exempt transfer made within 7 years of death is included within the estate. And the total of that value is then subject to IHT, so up to the nil rate band, whatever that might be. It could be 325, it could be more if they have other nil rate bands available. Is charged at 0%. Above the nil rate band is charged at 40% IHT, or if a certain amount of the estate has been left to charity, then potentially 36%. And the graphic on the right-hand side just shows generally how the IHT rules work. So if you made a failed potentially exempt transfer within the 7 years before death, then that's returned to the estate, and that uses up the nil rate band first. In this example, the rest of the estate is worth 300,000. That's placed on top, if you like. So it's that sits above the nil rate threshold, and it's the estate in this case that suffers the tax. So £75,000 excess suffers 40% IHT, so a 30% bill charged against the estate. So all of these rules are contained in the IHT Act 1984, and there's two key sections for our purposes today. So there's section 3, which is all around transfers of value, and that section is simply saying that there has been a loss to the estate. So the estate has been reduced in value. That section is subject to section 10, which basically says that there is intent to reduce the value of the estate. So it's not enough that there is a reduction in the value of the estate. There has to be some intention or some awareness on the part of the individual to actually try and reduce the value of their estate, or be aware that it's being reduced by whatever action they've taken. And it's these two rules which are particularly important for pensions and inheritance tax. So just an example, hopefully, to add a bit of detail to that. So if you make a gift of cash or a property, say to a child, and that clearly, there's clear intent to make a gift, so the estate has been reduced by the amount of that gift, and there is obvious intent to give that money away. So that is an inheritance tax transfer of value, because it meets both of those conditions under the sections on the previous slide. However, perhaps if you made a payment to an ex-spouse under a court order, and even though the estate is reduced in value, there's clearly no intent on the part of the individual to actually try and reduce the value of their estate. So there's nothing really being given away voluntarily. And as I said, it's that difference which becomes important when we talk about pensions and inheritance tax. So the general overarching statement about pensions is that they are free of inheritance tax. There is one major exception to that, and that is that if the death benefits are payable to the estate, then that obviously negates any IHT efficiency within the scheme. But fortunately, that can generally be easily avoided. So if they are to be payable to the estate could be left to a spouse or some other exempt beneficiary. But that probably isn't the best approach. What you would rather do is choose a pension scheme that pays death benefits in an IHT efficient way. So perhaps pays those death benefits under a discretionary rule. So discretionary trustees utilise a nomination to decide the best person to pay those benefits to. That's highly IHT efficient. Not all schemes have that, but they might have something similar. So some schemes allow you to simply nominate a recipient. There's no discretion, but you can nominate a recipient to receive the death benefit. So, for example, Nest have something along those lines. So most schemes are IHT efficient in one of those ways. Some older style schemes aren't so much, like retirement annuity contracts, but often they allow you to execute a trust over those death benefits. So there's usually a way to avoid that quite straightforward kind of IHT sort of drawback, and that is just simply making sure that the death benefits are paid in an IHT efficient way, and most schemes allow you to do that these days. Outside of that, then there are really three main situations to be aware of where a pension can be subject to inheritance tax. And these all arise where the member is in ill health and they do any of the following three. So make a contribution, assign the death benefits, or make a transfer to another scheme. For it to have an IHT transfer of value under those sections we mentioned, then the death benefits themselves have to have a value. One of those three things has to occur near death, which HMRC generally take to mean within 2 years of death, and in some way they can demonstrate that there's some intent or awareness, and that's usually left to HMRC or potentially the courts to decide. So a pension contribution, for example, reduces the cash value of your estate, so there's a transfer of value for IHT purposes. And the answer in normal health is no. So you might pay $160,000 using the carry forward rules as a large amount out of your estate. The cash value of your estate has been reduced. Your pension fund has been increased, but what you've got back into your estate is a more secure retirement in the future, and that could be calculated and worked back to the present day to give you a value today, and that's likely to be more than the contribution you've paid. So under that Section 3 IHT rule, there is no real loss to your estate. That all changes if you're in serious ill health when you make that same high level of contribution, so $160,000 out of the estate, because the member's in ill health and are unlikely to benefit from any increase in their retirement fund. What you're actually doing is therefore increasing the death benefits within the pension. So under those two IHT rules that we mentioned, there is a loss to your estate that can be easily calculated, and if the member is aware of ill health, therefore aware that they're probably not going to get any of that fund back, and you could say there is some intent to reduce the value of their estate, and HMRC could therefore try and attach a transfer of value for IHT purposes to that. Okay, so just to look at contributions and assignments of death benefits together and in a bit more detail. So third-party contributions are almost always transfers of value for IHT because you're giving money away and you're not getting anything back. However, they are usually covered by some form of exemption, so either the annual exemption or the normal normal expenditure out of income exemption. So contribution to your own pension or assignments of death benefits whilst in normal health are therefore not transfers of value because there's no reduction in the value of your estate. Contributions are offset by the increase in retirement benefit, as we discussed on the previous slide. Assignment of death benefits have a slightly different treatment. There's no reduction in the value of your estate because whilst you're in normal health, you could say the death benefits have a nominal value. So assigning them involves no loss of value to the estate. And all of that changes, again, in serious ill health. And HMRC have the following approach. So generally, they only try and attach an IHT transfer of value if the member was aware of ill health at the time, and they only investigate contributions or assignment of death benefits made within 2 years of death. And that's their kind of quite arbitrary cut-off to allow them to decide which contributions or assignments were likely to be made whilst aware of ill health. HMRC's form is relatively clear on that. So the IHT 409 that the executors fill out, and it does say on the form contributions to a pension within 2 years of death and transfers of or changes to pension benefits again within 2 years of death. So that's where they gather the information, and from there they investigate the client's circumstances to determine their situation at the time. Okay, we'll just skip past these examples. Moving on to the final of those three situations, so transfers, which is perhaps the most complicated of the three. So HMRC's inheritance tax manual says a scheme member can transfer to another scheme, even if there is an irrevocable nomination over death benefit. That falls away. What HMRC say is that the funds don't rejoin the estate when they do that. What happens is the right to determine who receives those death benefits does, and potentially the member could redirect them to their own estate. So HMRC's view is that that can result in an IHT transfer. In normal health, as we said, death benefits have a nominal value only, so there's no issue there. However, if the member is in ill health at the time, then there could potentially be an IHT transfer of value. So as with contributions and assignments, the same 2-year rules apply. And again, it's for the HMRC and then perhaps the courts to decide if the member was aware of ill health when they did that. And as I'm sure you're aware, this approach was tested to some extent in the recent Staveley case. So just a very brief overview of that case. So the case revolved around a disputed inheritance tax charge following a pension transfer. So Mr. and Mrs. Staveley owned a company which ran an EPP. This sort of came to an end roughly in the early 2000s. They divorced and her benefits were transferred on to a Section 32. However, under the pre-A-Day rules at the time, it was possible excess benefits within that Section 32 could have been returned to her employer, which just happened to be her ex-husband. So to try and sever that link, she transferred on to an AXA personal pension. She didn't need to do that because the post-A-Day rules had removed that possibility anyway, but it still created intent to stop her husband benefiting rather than to reduce the value of her estate. But she was in ill health at the time when she actually transferred, so she met that requirement, and she died shortly afterwards, so again meeting the 2-year requirement. So HMRC calculated the value or a transfer value for IHT purposes and included it in her estate. But the Staveley family took this to the First Tier Tribunal and won. They also won the subsequent appeal as well. But then the appeal to the High Court eventually found in favour of HMRC, and then went on to the Supreme Court. This whole thing took about 15 years. But the Supreme Court eventually found in favour of Mrs. Staveley's family on one of the 2 points, which was the pension transfer. The other point the omission to act is no longer relevant today. But the case was complex and had very specific circumstances, but we believe it does clarify some aspects of the pension transfers and IHT rules. So, for example, we now believe that a transfer from a defined benefit to a defined contribution scheme, because it usually improves the death benefits, and now above £30,000 it has to be advised, and then it would be hard to argue that the member was not aware of the increase in the death benefit position, and if they're in ill health at the time, then it might be hard to argue that they're not aware that they're reducing the value of their estate at the time. So we believe that DB to DC transfer now in ill health will usually create some IHT consequences. That doesn't necessarily mean you can do it. It just means that you've got to be aware of the potential IHT bill as a result of doing that. But quite helpfully, I think we now believe, and a lot of other providers do that, a defined contribution transfer onto another defined contribution scheme with no improvement in the death benefits shouldn't result in an IHT transfer, as there's nothing really to base an IHT charge on because the before and after picture look broadly the same. HMRC haven't updated their guidance on this, and that's just a kind of a provisional position, but we believe as long as there's no improvement in the death benefits, that should be okay and should not have any IHT consequences. Okay, so just to summarise that before moving back to the intergenerational planning point. So in most circumstances, pensions are not subject to inheritance tax. The main situations where they are one, the death benefits are paid to the estate, which is usually quite straightforward to avoid with some forward planning, or two, if there is a member in ill health and does either of those three things, so either contributes, assigns a death benefit, or transfers from one scheme to another. And if they die within 2 years, then there is scope for an IHT transfer of value to be included within their estate. Obviously, those will only apply very occasionally. So in most cases, your pension should be IHT efficient. So a pension with death benefits held under a discretionary trust, for example, where the member is in normal ill health, should not be subject to any IHT charges. And this, combined with the death benefit points we mentioned earlier, this ability to pass funds down through the generations, can result in a pension being a very IHT efficient vehicle. So a very simple question: then can a personal pension be used for IHT planning? And I think the first thing to say is that in most cases it's going to be unrealistic. So in most cases, your pension fund, the primary purpose will be required to provide for your retirement, and in some cases it might not eventually be sufficient to provide for your retirement. But those minority of people who are in good health, who have sufficient funds outside of their pension and perhaps excess cash to invest in their personal pension, may be able to reduce their IHT bill. So they could make annual contributions up to £40,000 each year. That's subject to having sufficient earnings and annual allowance to be able to do so. They did that for 10 years. That could potentially remove £400,000 from their estate. On the member's death, the trustees could pay a lump sum to the beneficiary, or even better, they could set up beneficiary drawdown. The beneficiaries could leave those funds in drawdown, which is outside of their estate in an IHT-efficient vehicle, but fully accessible under the drawdown rules if they need them. A further nomination could be made by that beneficiary, and that would be a successor, and that allows beneficiary drawdown to be passed on again. So potentially funds can be passed down through the generations in this manner, whilst always remaining in an IHT-efficient pension environment. There will be other things to consider along the line, other taxes to consider, such as the LTA charge, potentially any marginal rate income tax, where a beneficiary or the member has died over age 75, and complying with the 2-year payment deadline to make sure for a pre-75 death, the payment of death benefits is as tax efficient as possible. And this final slide just illustrates that point. So the scheme can bypass the member's estate and the beneficiary's estate, and leaving the funds in beneficiary drawdown, but accessible when needed. Your scheme might not have a beneficiary drawdown option, in which case your lump sum might be the only option, and which will then have to be paid to a beneficiary's estate. So only in some circumstances is this potentially viable, and it's down to the client's individual circumstances as to whether they can. But potentially, a personal pension can be used in this manner and could be used to save some inheritance tax for a client in the right circumstances. We've got a variety of articles and content covering all of these subjects. So we've got numerous technical articles, one looking at the key factors of intergenerational planning, and also another article entitled Money Purchase Pensions and IHT Planning, both of which discuss a lot of the things that we've talked about today. I've also got an FAQ, a death benefit article, and hopefully they've been available for you to click on the side of the screen throughout this presentation. Okay, that is all the technical content that I have today, so I'm going to hand back to Lena to go through any questions that have been submitted.
Thanks, Tom. Yeah, great session. So we've got a few questions that have come through. So if I start off with this one. So what taxes apply to death benefits paid to a trust where the member dies post age 75?
Okay, so on a post-75 case, then it's marginal rate tax for the beneficiary, but where the beneficiary is a trust, then that tax will be the top rate of tax, the top rate of income tax, which is 45%. So it'll be a heavy kind of tax charge going into the trust, but there is some scope for that to be reclaimed when funds are then paid out of the trust, but it can act as a significant drag on the performance of that fund. So perhaps best to be avoided if it's clear the member is going to survive beyond age 75. It's perhaps better to pay direct to the beneficiary rather than to the beneficiary via a trust.
Okay, thanks, Tom. Next one. If we have a scenario where a client has nominated their spouse and 2 children as beneficiaries, probably with the spouse at 98% and the children at 1% each, to ensure they're entitled to drawdown, is there a way of making sure does that make sure they're entitled to drawdown should the spouse predecease the client?
Yeah, so it certainly nominates them as a beneficiary, and that nomination then makes sure that they are entitled to beneficiary drawdown. And this has been suggested as a possible route to ensuring that is the case. The drawback with it is that the scheme may take it completely literally and pay out 98% to the spouse and then 1% to each of the beneficiaries. But you'd hope the scheme would apply their discretion and actually pay to the spouse if she is alive, or use the nomination to be able to set up beneficiary drawdown for the children. So it is possible. There's just the drawback that the scheme might not have the absolute clear guidance they need via the nomination form, but it's certainly something to consider, yeah.
Great, thank you. Next one we had in was, because obviously there's a different range of providers out there, but if a pension scheme doesn't offer beneficiary drawdown, can the death benefits be transferred to another scheme that does?
If beneficiary drawdown isn't available, then that can be a problem, and it could just leave you with the lump sum as the only option. But some schemes will, where they don't offer beneficiary drawdown, they will allow some form of notional transfer into something that qualifies as a drawdown account without actually being drawdown, which would then allow you to transfer that notional drawdown onto a real beneficiary drawdown with another provider. So not all schemes have beneficiary drawdown, which prevents a lot of the planning points we've mentioned, but some will try and facilitate a transfer by allowing you to set up this notional drawdown account, yeah.
Great, thank you. This one's slightly more complex, but what happens to the death benefits pre or post 75 if the member hasn't completed an expression of wish? Would you still have the options of lump sum or kind of drawdown, depending on what the beneficiary, the next level of beneficiaries might want once they were found?
Yes, so if there's no nomination form, then the scheme doesn't have a lot of guidance. But if there's no nomination and there are no other dependents, then that does, by default, open up all of the options. So it does potentially allow the scheme to pay a lump sum or a beneficiary drawdown to anyone. But the problem, as I said in the presentation, with relying on that default position is if it does turn out there is a dependent somewhere or there is a nomination somewhere, then you've excluded all other non-dependent nominations, so on the non-dependent, non-nominees. So it's best to try and make sure the nomination form is completed, it's kept up to date, and it's amended as circumstances change. But there is potential to set up beneficiary drawdown where there is not a nominee, provided there are no dependents.
And there's a follow-up to that one as well, so it was in two parts. So would it make any difference if there wasn't any kind of immediate family, but there was some extended family, so like cousins and things like that? Would they fall under the dependent category, or would they not?
Wider family generally won't count as dependents. So generally, dependents are spouse, children, anyone with a kind of financial interdependency. So generally, wider family will be excluded. But certainly, the scheme could try and pay to wider family using their discretion. So they certainly have that option. But if they don't qualify as a dependent and they weren't nominated, then often the only option will be for them to set up to pay out a lump sum. So they might be in a position where it's better to actually nominate some wider family if they wanted them to have beneficiary drawdown rather than the only option being the lump sum.
Okay, great. And then I think the last one for today, then, Tom, for the time we have, is it's a question really around the ability to change beneficiaries post-death. So if you had a scenario where the spouse was nominated 100%, but the spouse didn't need the benefits if the event happened, what flexibility is there to make any changes to that nomination?
Well, again, the scheme have discretion, so they usually have the option to perhaps have a discussion with the spouse and maybe decide that they're better directed elsewhere. But if the spouse was the only person, the only dependent or the only nominee, then you might end up in a situation where even if you want someone else to benefit, and that is potentially possible, they may be unable to receive drawdown because they haven't been nominated as a beneficiary. So that's the real drawback. But yes, that flexibility is usually there because the scheme have that discretion. They've got to decide who is the most appropriate person. But these quite complex rules around drawdown mean that someone who probably would prefer drawdown as a death benefit might not be eligible for it because they're not a dependent and they weren't nominated to the scheme.
Okay, great. And we just have one more that's just squeezed in, if we can, Tom, just before the end.
Yeah, sure.
So if a member dies pre-75 and their beneficiary decides to take a pension rather than a lump sum, will the new plan be completely tax-free if the latter decides to take a future lump sum and or income?
So if the member died pre-75, then those benefits will be tax-free for that beneficiary. They could set up beneficiary drawdown. At some point later in the future, they could draw a full lump sum from that policy. But if the member died pre-75, then that first beneficiary gets those benefits free of income tax, but not necessarily free of a lifetime allowance charge. If that beneficiary then dies over age 75, then the next beneficiary in the chain would then be subject to income tax on the benefits that they received. So it's always linking back to not necessarily the age of death of the member, but the age of the most recently deceased person who passed those death benefits on.
Great, thank you, Tom. So that brings to close this part now with the questions. So it has obviously been a bit of a whistle-stop tour, as you can imagine, with the time period we have to cover off death benefits and IHT planning. So thanks, Tom, for leading us through that. So just to recap the learning outcomes. So I'll just put those back up on the screen for you. Recap the 2015 changes to defined contribution death benefits, outline the inheritance tax treatment of the pension death benefits, and detail how beneficiary drawdown may be used for intergenerational planning. So great to have you all on the call today, so thank you for joining us. And as I mentioned at the start, the recording of this session will be emailed to you tomorrow. We'll also put together a Q&A document of anything that we didn't have time to cover off today. So please do get in touch with your relevant relationship team if you've got any other specific questions that you'd like them to deal with too. And as we close this webinar, a feedback survey will appear on your screen. This shouldn't take any longer than 1 minute to complete, and it really helps us to plan future editions of the Expert Series. So it'd be much appreciated if you're able to leave your thoughts. So that's it for today. We hope to see you all soon again on future sessions. And once again, thank you for joining us.